All right, Matt, the mortgage guy here. Brace for impact, week of December 12th, 2022. Thanks for all you guys that are joining live. For anybody who's watching on replay, the events that we're going to talk about in this live may have already passed, but the effects of them maybe haven't, right? The week of December 12th, 2022, we've got a bunch of market moving things going on. First and foremost, in less than 24 hours, we've got the CPI number, Consumer Price Index, otherwise known as inflation, coming in for the month of November. So December 13th, we get November's reading. November 10th, we got October's reading. And if you don't remember, I shall remind you, November 10th, when the inflation readings came in a lot lower than expected, you talk about market mover, best single day in mortgage-backed securities on record, I think. We got something like 200 basis points improvement back on November 10th. Here's the thing. I don't think that's happening this time. And last time, I was correct in saying that inflation is going to come in lower than expected. It's going to have a positive impact on mortgage rates. I just recorded a video that's going to be released tomorrow where I said some of this same stuff, but I'll share it with you here. If you're live, you're catching this before it hits on my channel. Last month, the expectations for inflation, top line number, were 8.1% for year-over-year readings. That came in at 7.7, a lot better than expectations, and the markets rallied. Mortgage rates got significantly lower all in one day. 0.6 was what we expected for a month-over-month reading. That came in at 0.4. So both numbers, month-over-month, year-over-year, much lower than expected back in November. Markets rallied. Mortgage rates got significantly better. It was a good day for buyers, for mortgage lenders, for real estate agents, people in the stock market. In general, this kind of stuff happens. It's going to help the stock market rally. This month, the expectations, because there's all kinds of surveys and who thinks what, are that inflation is going to come in at 7.3 year over year and 0.3 month over month. So the market is already baking in the fact that we think inflation is getting better. Now, depending on what they come in at tomorrow is going to dictate what happens with mortgage rates, what the Fed talks about on the 14th. And that's why this week is so important, because December 13th, tomorrow, inflation number, CPI, gets released, 8:30 Pacific Standard Time, which means you guys get it, or we all get it, right? 8:30 Eastern. So 5:30 in the morning for us here on the West Coast. That's Tuesday the 13th. Wednesday the 14th, the Fed is going to have, their announcement from their December meeting on what they're going to do with the Fed funds rate. They're more than likely to announce a 50 basis point hike, but that's not what we all should be looking at. We all should be looking at, what are they going to say? What they say, I promise you, is going to have a lot to do with Tuesday's inflation number. I promise. They're either going to say, holy moly, inflation number came in at 7.6. We were expecting 7.3. It came in at 0.4. Month on month was higher than we expected. We don't have as quite control of inflation as we thought. We need to probably do a 50 basis point rate hike in February and a couple more to follow that. We're going to tighten the reins. That's going to have a negative impact on mortgage rates. Or it meets expectation or beats expectation, coming in at 7.1 year over year, 0.2 month over month. And then it's like, look at us. Look at how much we've come. Look at these last 2 months readings. We're on our way. Inflation is coming down. We're going to do probably 25 basis points in February, but after that, we can take our foot off the gas. This inflation is coming down. It's going to continue to come down. We all know there's a lag. We've done our job, all of that stuff, right? Tuesday's going to have effect on Wednesday. Wednesday, what the Fed says is going to have an impact on mortgage rates for probably the rest of the year going into 2023. So stay tuned for all that stuff. What's the business market rate? Hello. This is a live Q&A. So I wanted to start with some of that, talking about what we have coming this week. Any questions you have on that, mortgage rate specific, mortgage guidelines, what kind of, questions you have about if you qualify, why you qualify, when you qualify, what investment property down payment you need, whether you can do a 3-unit FHA purchase with 3.5% down. All these questions, please keep them coming because there's only so long I could talk about the nitty gritty, inflation and whatnot. The gist of this whole intro is that this week is going to have an impact on mortgage rates, depending on what inflation number says tomorrow, December 13th, and then how the Fed reacts to it on December 14th. They don't always coincide where the Fed meets or is meeting when the inflation number is received. But nonetheless, let's jump into some of your questions. What's the business market rate? Not sure what you're asking, Jennifer. I appreciate you coming. So please follow up. Let me know what business market rate. Maybe you're asking about investment properties. I'm not quite sure. Ghost reporting. What does ghost reporting mean? Ghost reporting. I got to Google this stuff because you guys. Reporting a ghost. I don't know what ghost reporting is. Ghost reporting definition. Oh, a quote from a computer game? Okay. I thought it had something to do with what we're talking about. So I was trying. That would be a huge drop in CPI. Well, it's at 8.1. I'm sorry, it's at 7.7. It's at 7.7 as of last month. So going down to 7.3 isn't a huge drop, right? Month over month, last month was 0.4 and they're projecting 0.3. So not necessarily the biggest drop in the world. Like, we got to remember the summer months of 2021 had really low numbers. So the year-on-year stuff looked inflated during 2022, and then big uptick in inflation Q4 of 2021. So October, November, December readings don't even have to come in that low for that year-over-year number to come down. Diana P., this is a great question. I appreciate you asking it. Why do home builders make you use their preferred lender for incentives? Can you still get incentives with using your own lender you like? This is such a great question because it's really, in some ways, a mystery, but I had a conversation with the loan officer in my office as of yesterday. And my best reasoning for it, and right. And I appreciate this too. Like, your own lender with better rates. Like, as a broker, I'm going to have better rates than the builder's lender 99% of the time. Where they will win business is if they do 5, 7, 10, 14,000 in credits. And I'm like, listen, I'm $6,000 better. So they offer you 5,000 credit. I'm still better. They offer you 14. You're best served going with them. And I think for the builders, it's having control and visibility over everything. As much as I know what a thorough job we do pre-approving clients, and hold. All right, I think it's just one. All lenders aren't going to do that amount of due diligence. And so the builder, in order to really have the ability to see in and know that a loan is going to close, they have to have their own lender do it, right? Because imagine if you're Lennar Homes and you've got Lennar Mortgage down the hall. You can walk in there and say, hey, Susie, I'm looking at the Ortiz file. They're in contract on this one. and you skim through the Ortiz file. Yeah, look, works for the state, W-2 employee, 780 credit score. Wife works for the school district, W-2 employee, 770 credit score. They've got this combined income, debt to income ratio is this. Walk in the park. We know we're going to close on this loan. Gives them a little sense of security versus buyer saying, hey, I'm going to use my own lender. The builder doesn't really have that level of visibility into the file. As an outside lender, I'm happy to call on behalf of the Ortiz family and say, listen, I've got a full file. These are great people, very well qualified. Me and my office has a great reputation. We do not pre-approve folks that we don't get to the finish line. Rest assured, this file has been vetted. We've run the automated underwriting system. We've verified income and assets and credit. This one's going to make it to the finish line. That should give the builder some assurance, but the builder, I guess, is going to have even more assurance when it's in-house and they can walk down the hall to Susie. Susie's not as good as a loan officer as any of the loan officers on my team, but Susie's down the hall. That's really the only thing I can think of because, the builder is going to offer $12,000 incentive for using that lender, but nothing for using Matt, the mortgage guy team. Are you crazy? Builders, you got to hit me up. I can offer them the best rates, terms, and service. And you don't have to give away the whole farm, right? Just give me and the clients that work with me half of that, and we'll get you the same type of deal. Anyhow, a lot of people still use an outside lender, Diana. So I'd make sure that, if you're looking to get the best loan, you just have an outside lender you like and trust, kind of vet the deal. I looked at one today. I don't know who the home builder was, and I wouldn't blast him anyway, but it looked like a pretty decent deal from the builder's lender. The only problem was they had a loan set up at a 739 loan amount in a county where the limit is 726,200 on a 5% down, and everything about this thing said conventional, but you can't do a conventional loan at that loan amount. It would have to be a jumbo loan. So hopefully that in-house lender is doing the due diligence and they know they can get the loan closed. We gonna see, right? All right. People always want to talk about mortgage rates. While I'm waiting for questions to come in, please, if you're live, ask questions live. I want to answer them live. These questions that have come so far are amazing questions. I think that other people are going to find value in those too. If you're watching this on replay, ask questions in the comments. I am going to go through YouTube comments as I always do, try to answer as many of those as possible. In the future, I'm thinking about doing some monthly Zoom calls or something to answer as many people's questions as possible, because the goal is still the same. Empower people through education to make smart home buying choices and, get people to a level where they understand mortgage at enough of a level to not be terrified by it. Most people are, right? It's a necessary evil to get a home, and home ownership is the goal. Mortgage is the big scary hurdle. Doesn't have to be. It's relatively easy for most folks. If you're a W-2 employee, or even a self-employed employee, and you're just going out there getting a conventional loan, an FHA loan, a VA loan, it's not terribly difficult if presented in the right way from the right person who knows it well enough to explain it in a simplified fashion. So mortgage rates are bracing for impact. That's what my buddy Matt Graham over at Mortgage News Daily said. What's the average? 6.39, I think, is what they have as their average 30-year fixed today. Again, it's a good nationwide average. We don't need to look into the nitty-gritty of exact credit score for exact scenario. If you're buying an owner-occupied property, not paying any points to buy the rate down, 6.39 is probably what you're looking at. Got a lot of clients where we're structuring it in a way where they pay a little bit up front to get a 5.99. That's a sweet spot in rates, or others that are doing 2-1 buy down and other strategic things to lower their mortgage payment, get into a house. Theo B, thanks for joining. Appreciate you. Long time follower. Recognize the name as being someone who's been rolling for a while. What are your thoughts on a silent second, pledging one house as a down payment on another? When I've heard the term silent second, I've heard it for something different. I've heard it when you get down payment assistance, like you have a second with no interest payment due. It kind of sits on the back. There's no payments, no interest. It just gets paid off when you refinance or sell the house. And that's silent second from what I've heard. Your scenario where you're pledging one house as down payment on another is like cross collateralizing. And that's something that's done in the hard money space where it's like, hey, I need some money for this project and I want to buy this. And so you got to cross collateralize and put put a second on your primary home to kind of ensure that you're going to pay back this loan over here. It might be true that this is called silent second, doing it like this, but it's not common enough where I'm running across it at all, to be honest. I'll look into it though. Silent second. All right, Eric Cuellar, thanks for joining. The conventional loan limit increased to 763 here in Sacramento County. Thought I read that somewhere, wasn't sure. It did, Eric. And how they do this is the 726-200 is the conforming loan limit across the country. So across the country, you can get a conventional conforming loan up to $726,200. Then county by county, they're going to be increased limits. Not all counties, right? There's going to be the Fresno counties and the Riverside counties where 726.2 is all you can do. But in higher cost counties, it's going to be somewhere between that 726 number all the way up to $1,089,000. So in Santa Clara County, San Francisco County, high cost counties, Los Angeles County, you can go up to like $1,089,000 in loan amount and still be a conventional loan. Sacramento is 763,600. That's their high balance limit. I'm fairly certain that Sacramento, Placer, and El Dorado counties are all that same number. They all roll together at 763,600. So that's between 726 and that 763 is considered high balance conforming loans. But nonetheless, you can do everything you can do with conforming conventional loans as far as down payment goes and underwriting guidelines and things of that nature. Oh, this is a good question. Carlos Castillo, thanks for joining. I appreciate the heck out of this question. When I see national interest rates, can local rates be higher than national rates? I keep getting quoted higher than national in Seattle with perfect 800 plus credit score, 20% down, no other debt. While our pricers do have a zip code to input, I think that the better explanation for why you're getting quoted higher rates is probably the fact that you're talking to a lender with higher margins. Certain models are just going to have higher margins and higher rates. If it's a local lender that's in a retail model, they might be a quarter to a half a point higher in rate than a mortgage broker, for instance. Mortgage broker for 800 credit score, 20% down, depending on where exactly or what price point you're buying at, is going to be at or below that national average. And I think another thing to take into consideration is sometimes people are like, hey, I saw that the average is this rate and I got this rate. The lower loan amounts, you can plan on paying a little bit higher interest rate because lenders will put in place adjustments less than 125,000 loan amount, some less than 250 loan amount. Then you start getting into a bigger $500,000, $600,000, $700,000 loan amount. Lenders are willing to do them at a thinner margin And think about it. If a lender is going to make 1% of the loan amount as a commission, and your loan amount is $150,000, that might be $1,500 commission. Now you've got a $600,000 loan. They can do it at a 0.5% commission and make $3,000, make double what they'd make on that smaller loan, and offer you a better rate because they're squeezing their commission in half from 1% to 0.5. So the bigger loan amounts are going to get better rates. Twofold reason. One, because the lender incentivizes it because they want bigger loans. And two, the loan officer getting the commission is able to squeeze their margins because they don't have to make as much on the bigger loans. I'm curious what you're seeing or hearing out there, Carlos, as far as a rate goes, and what the purchase price is. Because 800 credit score, 20% down, you should be getting a pretty sweet rate. Carlos, just type in. I mean, in Seattle, you're not getting anything for 300 grand. I know that. So I'm guessing you're playing in the $600,000, $700,000, $800,000 realm when it comes to purchase price. Let's see, sales price 6.25. I'll be conservative. $500K loan amount. Purchase home. Oh, condo. That was something. Property type. You're going to have a small hit. Usually it's like a 75 basis point hit. So that's about a quarter in rate for a condo. Depending on if it's attached, detached condo, some lenders are going to have a hit for that. So do you know if it's attached or detached? Because you might see a hit for that. And what's the purchase price? Oh, $700K. You said that. So $700K, 20% down. Let's take a look-see-loo. See if it's the lender, the property type, or something different. Okay, attached. I put attached because that's what my guess was. $800 credit score, $700. I can't give you an exact quote because there's compliance issues, but I'm going to give you a range. I'm guessing that lenders you've talked to have quoted you. All right. Conventional, elite. What are we working with here? Oh, man. Yeah, 75 basis point hit for condo, which means on the rate sheet I'm looking at, if it wasn't for that condo hit, you'd be mid sixes. But because of the condo hit, you're high sixes. Not an intent to lend, just giving you, the range, rough ideas. But yeah, I mean, that's how much that 75 basis point swings it, 6.3 to 6.8, because of the attached condo hit. Fannie and Freddie, who everyone's brokering to, is going, or everyone's selling to, is gonna charge you a little bit more for a condo. It's considered a little bit higher risk, so that's why it's slightly higher, Carlos. Whatever the case, if you want to take a look, talk to me and my team, we're more than happy to help. I'll give you a smoking deal. Just say that we're chatting on YouTube Live. My team will know what to do. GreatMortgageBroker.com. Fill out the form. Let us know where you're at, how we can help. I'll set you up nice. We're going to see if you're not in contract yet, if you're currently just shopping. It's going to be one of two things. Either you're going to be able to get much better rate and you're going to be excited by the end of the week, or you're going to be like, holy crap, I wish I would have been able to lock in at that 6.875. And keep in mind too that these rates are without paying any points. You can you can throw a little bit of money at it. And, that 75 basis points on that big of a loan, when you're putting 140,000 down on 700 and you got a 560 loan, for $5,000, you can buy it into the low sixes. If you're able to get credit from the seller to buy it on your behalf, always better than spending your own money. Hopefully that was helpful. All right. Abraham, thanks for joining. I know you're correct with your last call on inflation. What's your call on tomorrow, and what makes you think that? To be completely honest, Abraham, I haven't done a ton of digging into things as much as I did last month, on the cost of different things that go into this CPI report. So let's start with that. Less information than I had last go around, but I think that the 7.3 top line reading and the 0.3 month over month, that is kind of expected and probably baked in, is probably pretty accurate where we're going to land. I don't think we're going to have a huge beat like we did last time. It would be nice because it would be great for rates. I just don't think it's going to happen, so much so that I've got clients that I'm getting locked in today to avoid rate slide that will come if we miss those targets. Last month was some educated analysis and some lucky guess. Thank you, Abraham. I appreciate you. Appreciate you being here. Next week, guys, I've got a special guest. I've got a loan officer from Florida who knows a ton about how to help immigrants to the U.S. that have work authorization, work visa, green card, become homeowners, getting them pre-qualified, getting them into a home. I'm excited to have her on too, because as we talked, my wife is her family comes from a family of immigrants to the U.S. I've got so many friends. You can imagine in California, a true melting pot of immigrants to the U.S. I work with plenty of clients who are here, who have, first, second, third generation, along with those that are, currently on work visas with green cards, on work authorization. And it's really special to be a part of those transactions and helping those people become homeowners. There's a lot of misconceptions around becoming a homeowner in the U.S. I just had somebody from Australia tell me that they thought they were going to get, a higher interest rate, and they thought they're going to have to put a bigger down payment because of the fact that they were from Australia. Just not the truth, right? If you qualify, you qualify. And if you're here on a work visa that is expected to continue, which most are, you're going to qualify, right? And you're going to use the same qualifications that U.S. citizens who are working here in the U.S. are following. So next Monday, if you have any questions about how to qualify for a home loan in the U.S. on a work visa, on a work authorization, on a green card, make sure that you join next week, because that's going to be a good conversation with a fellow loan officer who's really passionate about helping those folks get into homes. Philip Hoyle. I don't know if you are in the wrong room, but my girl wants me to treat her like a booty call, but I refuse to do it. Plus, I hate the telephone anyway. Tough, I guess. I was going to try to spin this mortgage related. I just can't think of anything off the top of my head. So I guess we'll just move on. Last time Jerome Powell spoke, I'm going to quote some of Maddie Graham from Mortgage News Daily, because I think it's important to think about as the theme of this live is talking about this week specifically and the Fed and their moves like in reaction to the CPI number. And so, I'll give proper sourcing here. I'm reading from Matt Graham at Mortgage News Daily. The last time Powell spoke about the Fed's policy outlook, the market cheered what they saw as a softening in the Fed stance, which I think it was, right? Because interest rates were, inflation was softening. Indeed, many Fed speakers agree it's time to soften, but not time to become soft. Instead, they want to continue hiking rates, just at a slightly slower pace. From there, they've been unified in calling for rates to remain at the ceiling levels for as long as possible. It would take a big sustained drop in inflation for that to change. When they talk about keeping them at higher levels for longer, there was actually a cool little piece from Meet Kevin today where he showed historically how long the Fed keeps their Fed funds rate at the ceiling. And I think the average over time was like 11 months, right? So if they hike this month, foregone conclusion, hike again in February, and then pause, it's more likely like that pause remains for most of 2023 until they do any sort of Fed rate hikes or Fed rate cuts, cut other direction. Both the market and the Fed will take a big cue from tomorrow's CPI data when it comes to assessing the prospects for a drop in inflation. This one report isn't enough to single-handedly change the narrative, but it can provide a big push in one direction or another. And I'll add to that, Maddie, that it won't single-handedly change it, but man, if we got another good read like we did last month, that's 2 in a row. That's the momentum in the right direction as far as rates are concerned. Bottom line, the last CPI report was responsible for the biggest single-day drop in mortgage rates on record. Like I said, November 10th, woo, that was a doozy. Tomorrow's CPI offers a chance to validate or push back. Tomorrow is going to be either like, look, we saw it start in November. It's happening. Inflation's coming down. Mortgage rates are going to follow. Or it's going to be like, yeah, we told you that was just a blip, man. Like, inflation is not under control. The Fed needs to continue to do their tightening thing. Doesn't mean it'll be another record-setting day, but there's every chance for it to see some very big movement. Agree 1,000% with all that. Reiterating what I said, if you like it, lock it today in advance of all this volatility we're undoubtedly going to see on Tuesday and Wednesday. If you were to ask me, meet expectations or be worse, I think meet expectations in the middle with the least amount of volatility is probably the most likely. Pretty bullish guesstimates out there and pretty bullish expectations. 7.3 year over year, 0.3 month over month. So it's going to take some pretty wild numbers to beat that. The scary part, I think, for me and why I really lean towards locking it more than I lean towards like, oh, we might gamble and get better, is because it's going to be hard to beat. So Kevin Hawthorne, good evening to you. Great to see you. Hopefully you guys can tune in next week where we talk to my friend Julia from Florida, who's really a specialist in mortgages, specifically with mortgages for folks with green card, work authorization, and work visas. I'm going to cut it short today because I've got a lot of work to do. We got some people in contract. We want to get people locked. We don't want to gamble with some of this market volatility. So if you join me live, thank you. I appreciate you. Come back anytime on a Monday. Fire away your questions. If you're catching this on the replay, feel free to leave comments down below. I will answer them the best I can, as fast as I can. And until next time, we gonna see.